In January 2026, silver didn't rally. It snapped into a 65% monthly surge, a move silver has printed only twice in the last half-century. And that one candle just opened a dangerous window where the next 60 days can either create life-changing gains or trap late buyers for years. I'm here to break down market patterns like a trader, not like a headline reader. Now let's get clear on what happened, fast. Silver just posted a 65% month. In 52 years, that exact type of monthly acceleration has happened only in February 1974 and December 1979. This is the third time. And both earlier times led to wildly different outcomes. Same trigger, different aftermath. That's why January 2026 matters more than any daily candle you're staring at. A 65% month is not strong, it's parabolic behavior. It's the chart going vertical, where normal pullbacks disappear and every dip gets inhaled. That sounds bullish, until you remember one thing. Parabolas don't end politely. They end by ambush. So we're going to do this the smart way. We're going to walk through the two historical matches, what happened right after each one, what the crowd believed, and how silver punished the maximum number of people. Then we'll bring it back to today and define the decision zones that keep you from round-tripping gains. First, December 1979. The backdrop was fear and inflation. People weren't concerned about purchasing power. They were watching it evaporate in real life. Confidence in the dollar was cracked. Precious metals weren't a hobby. They were an escape hatch. And in December 1979, silver printed that same signature, a 65% monthly gain. The market flipped from interesting to urgent. Attention spread outward in a wave. Diehards first, then early winners, then cautious money, then the crowd. Same psychology you're seeing today, just slower distribution because it wasn't happening on a phone screen. After a monster month, the market often does one last seductive thing. It continues. It rewards late buyers just long enough to convince them they were right. That's exactly what happened. After the December 1979 surge, silver pushed higher into January 1980. The bulls felt invincible. Selling felt impossible. Every new high made people feel smarter. And that's the trap. The moment buying feels safe is usually the moment the market is most lethal. Then January 1980 became the peak zone. Silver spiked to roughly $50 an ounce, and in the moment, it looked like the beginning of a new era. It wasn't. The reversal hit hard and fast, not a gentle pullback, a violent unwind. Leveraged positions got forced out, late buyers got crushed, and the damage wasn't only financial. It branded the market with a memory. That peak became a scar for decades. It wasn't just a number, it became a trauma line. Every time price approached that zone later, selling showed up like a reflex, because history teaches participants to fear the same place twice. Now hold that thought, because it connects directly to your situation. If January 2026 is the 65% month that rhymes with December 1979, the real question is not up or down tomorrow. The real question is, do we get the second leg? In the 1979 template, the 65% month was not the end of the move. It was the signal that the endgame had started. Endgames are where people make the most, and where people lose the most. Because the market often tries to do one more thing before it turns. It tries to go high enough to create capitulation in skeptics and euphoria in bulls at the exact same time. That's how tops form. Not when people are scared, when people are certain. And certainty is expensive. Now let's go to the other historical match, February 1974. This one is the silent killer because it doesn't wipe you out in a week. It wears you down over years. In early 1974, silver also printed a 65% monthly gain. Same rarity, same shock, same "this is the breakout" narrative. The crowd expected continuation. But instead of a blow-off extension and a crash, silver delivered something worse for most investors. Time. Price action didn't collapse, it didn't explode, it chopped, it drifted, it lived in a range. Month after month of, why isn't it moving? Years of boredom that made people abandon positions out of frustration, not out of analysis. And that's the trap of the consolidation prison outcome. Sideways markets don't kill you with pain, they kill you with exhaustion. They make you quit right before the later breakout that finally rewards patience. So now you see the crossroads. Same trigger, a 65% month. Two outcomes. The 1979 path, continuation into euphoria, then a brutal reversal that punishes late buyers and leaves a long-term scar. The 1974 path, a surge that looks like the start, followed by a long range that tests your patience until most people give up. And January 2026 just printed the third 65% month. So which track are we on? Here's the honest answer. You won't know with certainty until you're already inside it. That's why predictions are less useful than planning. Your job is not to be a prophet. Your job is to survive both scenarios. So let's get practical. A parabolic phase is a volatility machine. You will get huge up days and brutal down days. You will see liquidation cascades, stop hunts, and news that sounds like a reason to panic. None of that is a bug. It's how parabolas transfer wealth from emotional traders to prepared ones. The oldest trick in the book is simple. They convince you the dip is the start of the collapse, right before it rips higher. Then they convince you the pump is the start of a new era, right before it drops. If you don't have a plan, you become the liquidity. Your fear becomes their entry. Your greed becomes their exit. So rule 1, stop making decisions based on the last candle. Make decisions on structure and zones. And rule 2 is the most important survival skill in this entire moment. Scale. Don't guess. Scaling beats guessing because it works in both outcomes. If we're on the 1979 path, there is often one more extension leg that makes selling feel stupid. Scaling lets you take risk off without trying to nail the exact top. If we're on the 1974 path, the market can waste your time for months or years. Scaling lets you build a position without betting your entire future on one perfect entry. So what are the zones you should be watching? Think in bands, not in one magic number. In the 1979 template, after the 65% month, a second leg surge often shows up. The kind of move that creates mainstream attention, celebrity predictions, and the feeling that this time is different. When you see a powerful extension where price action becomes almost straight vertical again, that's when the risk of a blow-off reversal rises sharply. When that extension happens, the move doesn't end because the fundamentals changed overnight. It ends because the market ran out of fresh buyers at the top. So the danger band is the zone where the second leg becomes extreme relative to the base, typically the kind of 30 to 40% follow-through that turns excitement into mania. If price is ripping, sentiment is euphoric, and everyone is acting like gravity got canceled, that's where taking partial profits is not bearish. It's intelligent risk management. Because blow-offs don't give you polite exits. They give you one day where you feel like a genius, and then they erase months of gains before you can emotionally process what's happening. Now the other path. If silver shifts into a consolidation prison phase, the risk is not an instant crash. The risk is that you get bored, you lose conviction, you sell in the middle of the range, and you miss the later breakout. In that scenario, the winning move isn't constant action. It's consistent accumulation with rules. You define your core position, you build on weakness, and you stop trying to force the market to entertain you. Here's a brutal truth. Most people don't lose because they're wrong about silver. They lose because they're wrong about themselves. They can't handle volatility, so they sell into fear. They can't handle boredom, so they sell into frustration. Either way, they hand the trade to someone with more patience. Now, I know what you want from me right now. You want a single call. You want me to say, it's definitely 1979, or it's definitely 1974. Nobody can give you that honestly. What we can do is weigh probabilities based on behavior. The speed and violence of the current move, the emotional heat around it, and the way volatility has expanded are more consistent with late-stage psychology than with a calm consolidation setup. That leans toward the 1979-style endgame risk. But probability is not certainty, so your strategy must survive being wrong. Now we need to talk about the thing that wipes out the most accounts in parabolic phases: leverage. Parabolic moves lure people into leverage because the chart makes it look easy. People see candles, not risk. They think, if I just add leverage, I can compress years of gains into weeks. Leverage doesn't just amplify profit. It amplifies the probability of ruin. Because in parabolic markets, 20 to 30% drawdowns can happen quickly. If you're leveraged, you don't get to hold through that. The market holds you through it, and then it liquidates you. So ask yourself one question that cuts through all the noise. Can you survive a sudden 30% drawdown without being forced out? If the answer is no, you're not trading a market, you're renting time in it. Now let's address the emotional loop that destroys people during moves like this. They buy after the big up days because they feel late. Then a correction hits. They panic and sell because it feels like the start of the collapse. Then price recovers and makes new highs. They feel stupid, so they buy again, higher. Then it corrects again. They panic again. Buy high, sell low, repeat until broke. That's not bad luck. That's no plan. So here's the plan framework that works across both historical outcomes. If silver accelerates into a euphoric second leg, you scale out a portion and lock gains while your brain still works. If silver corrects sharply into a deep pullback, you add gradually, not emotionally. If silver enters a range, you commit to building your position with a schedule, not with hope. 3 scenarios, 1 system. Now I'm going to give you 2 tells, 2 behavioral signals that act like early warning lights. First tell, mania behavior. Near blow-off phases, the market stops caring about bad news. You'll see catalysts that should cool price, and price shrugs and keeps climbing. That's not strength, that's late-stage emotion. If you start seeing silver ignore obvious reasons to pull back, that can be a sign we're entering the final act of the extension. Second tell, prison behavior. In consolidation phases, every rally fails. Every dip feels like the start of a crash, and attention slowly dies. That's when the later breakout becomes most likely, not when everyone is watching, but when nobody is. Same setup, 2 different endings. The tells are different. Now let me ask you a question that will reveal how you're wired in this market. When silver is ripping and everyone is screaming higher prices, do you feel the urge to add because it's working? Or do you feel the urge to reduce risk because parabolas end violently? Be honest with yourself. One of those instincts is how accounts get blown up. The other is how winners stay in the game long enough to catch the next cycle. Now let's simplify everything we covered. January 2026 printed a 65% monthly surge, a rare trigger that has occurred only twice before in the last 52 years. February 1974 and December 1979. After the 1979 trigger, silver extended into a euphoric blow-off and then reversed violently, creating a peak that haunted the market for decades. After the 1974 trigger, silver transitioned into a long consolidation that exhausted investors for years before the larger trend resumed later. Same candle, 2 futures. And right now the market is choosing which future we step into. So here are the 2 questions I want you to answer in the comments. Which path do you think we get from here? The 1979 blow-off, then reversal, or the 1974 consolidation prison? And do you want a similar historical trigger breakdown on gold next, using the same rare candle framework? Now a short, simple CTA, because this is the part most people miss. The next 60 days define the next decade. Subscribe and turn on notifications, because if silver enters the second leg or flips into consolidation, you'll want the follow-up plan, not recycled headlines. And remember this one line because it will save you money. Parabolic moves do not end when the story feels finished. They end when the maximum number of people are convinced it can't end. Don't buy certainty at the top. Execute a plan while everyone else trades emotion. Now, where do you anchor that plan without pretending you can predict the exact top? You anchor it in behavior around structure. Parabolic moves usually leave behind 3 zones. A breakout zone where dips start getting bought aggressively, a midpoint zone where violent corrections often snap back, and an exhaustion zone where upside becomes crowded and reversals become more likely. You don't need the perfect dollar. You need to watch what price does when it gets there. Here's the psychological inversion that separates winners from liquidity. If price is falling into support and the mood is panic, risk is often lower than it feels. If price is surging into exhaustion and the mood is certainty, risk is often higher than it feels. And tops don't form just because everyone is bullish. They form when the last marginal buyer runs out of cash. You'll notice it when dips stop bouncing cleanly, intraday recoveries get weaker, and the market starts giving you sloppy rallies instead of violent V-shaped snaps. Now, not everyone should play this the same way. If you're holding physical silver, your edge is time. You're not trying to win next week. You're trying to stay positioned through a cycle without getting forced out by volatility. If you're trading paper silver, your edge is discipline. Size small enough to stay rational, because this market will whipsaw stops and punish ego. And here's what you should not do. Make an all-in decision based on one historical outcome. All-in thinking is how the market owns you. If you go all-in bullish and we shift into consolidation, you'll spend months angry at the chart. If you go all-in bearish and we rip into a second leg, you'll spend weeks chasing at worse and worse prices. So build a position you can hold, scale risk when the market is euphoric, and add exposure when the market is panicking. One last cliffhanger to watch over the next few weeks. Focus on the recovery after sharp down days. In a healthy expansion phase, sell-offs get absorbed quickly, and key levels are reclaimed with urgency. In a topping phase, sell-offs bounce weakly, fails at the reclaim, and the market starts rolling over while the headlines stay bullish. It's not the down day that matters, it's the bounce. So yes, it's happening again. A 65% month, only the third time in 52 years. A rare historical trigger. And a decision window where emotions will be weaponized against you. Don't trade the excitement, trade the structure. And if you feel yourself getting pulled by emotion, remember the two traps in this exact setup. Trap 1 is fear. A sudden drop makes you believe the entire move is over, so you sell the worst candle of the week, and then watch the market recover without you. Trap 2 is boredom. If the market stops trending and starts ranging, you start thinking, this was a waste of time, so you quit, and then watch the next leg begin after you've already given up. Those are the two ways the market wins. So your job is simple. Don't let volatility scare you out of your plan, and don't let quiet months talk you out of your conviction. That's why this 65% month matters so much. It doesn't guarantee the next move. It guarantees the stakes. And it guarantees that the next phase will be designed to pressure you, either with violent swings or with dead time. If you can handle both, you stay in the game. If you can't, the market will transfer your position to someone who can.